Trade profit taking. It's more profitable overall to close a winning out of the money option trade earlier and recycle the money into another trade. With OTM options, the faster and larger amount of time decay comes earlier in the trade, meaning OTM trades can on average be closed sooner than at the money or in the money trades. Close the trade at 70%. When filled on a cash-secured put right, we can place a good till canceled closing order on the trade, set at a price which banks 70% of the total premium receive on taking 70% from a trade. It's then more capital efficient to close and reinvest the freed up money into another trade, then wait to drain the much slower to decay last 30% premium out of the current trade. Profit taking isn't hard and fast, it's discretionary decisions because every trade plays out differently, so we monitor daily. Perhaps we'd take a quick 50% a few days after trade inception on a big stock price up move, a very good short turnover profit. Closing a trade for 70% of 4% is 2.8% return, coming on average after 18 days of a 30-day expiry trade in flat to up markets, which equates to 4.7% for 30 days, circa 56% annualized return. If all we ever did was continuously sell out of the money puts, it's prudent to expect covered call returns on assigned positions to be less than CSP, given the 2.5% minimum premiums on CC trade. But covered calls do have the potential for occasional outsize high returns via intrinsic gains on stock price if choosing to take that bet. Portfolio profit taking. Since the timing of a market correction or crash is unknown, to not at some point take portfolio profits off the table is a risk. Jesse Livermore was one of the great early innovators of stock market investing. He's often described as a legendary investor. He made and lost 3 fortunes. After the third loss, he killed himself. Maybe we can take some learning from that. He had said that one of the greatest regrets of his investing career was not taking profits. Unless we take the financial wins out of the marketplace, our winnings are only paper profits. We don't beat the casino until walking out the door with the winnings. The stock market game is probably most akin to a casino. Basically, we're hoping the market's general tendency to rise over time will persist for as long as it most benefits our more bullish-oriented trading strategy. Whilst bull markets tend to be extended and the power of compounding is really quite immense, thus it's tempting to continuously reinvest profits. Compounding using a wheel strategy won't be happening in a bearish market for growth stocks. It's really important to set a fixed time when profits will be taken, perhaps annually, which when month-on-month returns are consistent, allows some steady compounding against the growing portfolio value to further enhance profit making over the year.